Hi, and welcome to Macro Wednesday, where we talk macro, trying to make sense of markets that really don't make any sense, and answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today because I almost called this Inflation Wednesday. What? Inflation? I thought this was the Bond show. Bond with a D. For those of you who missed the episode the other day, the Bond show. Now, I'm not referring to there is inflation, but a lot of people think stimulus is inflationary. Is it or isn't it? So I was going to ask you, do you think government stimulus is inflationary? Well, I'll make it a little easier because I'm not going to answer the question just yet, but how about over the short term, say, maybe 3 to 6 months, maybe 9 months. How about the longer term, 1 year plus? So two different answers. We'll see what you think. Maybe they're both the same. I don't know. But I want to talk about first, stocks went down. Oh my God, I thought there was rules against that. And what do you think happened to interest rates today? Yeah, they went down too. I thought interest rates were going up. What is wrong with the markets today? Is it because the United States won a judgment from the World Trade Organization? So the Trump administration is going to place $3.1 billion of retaliatory tariffs against the EU. Is that what drove stocks down today? It could be. Is it because COVID case counts are going up? Shocking. No. Because it's the quarter end. Quarter end? Yeah, the quarter end. Look, this is when I shouldn't just say large pension funds, but pension funds, institutional money managers, anyone that is managing any form of an asset allocation model portfolio is doing their quarter end rebalances. And all that means is over the last quarter, stocks have gone up and interest rates have been, we'll just say, flattish. So if you have a portfolio that's, say, 50% stocks and 50% bonds, and needs to be that way every quarter according to your investment policy statement, that means right now you have to sell stocks to buy bonds, which is going to cause stock prices to come down and interest rates to come down as new buyers step in. And guess when that's going to be occurring? Between now and the end of the month. And there are over $100 billion that's going to be sold. I should say rebalanced, because probably technically more is being rebalanced, but 100 billion plus of stocks are looking to be sold, 100 billion plus of bonds looking to be bought. And lo and behold, stocks were down, bonds were up, and people were wondering why. Well, let's get into the macro data. And I think this is helpful to kind of look through it. Let's go back to Monday, because remember we started with South Korea's producer price index during the show, and then later on, Australia's preliminary. We got a whole bunch of preliminary factory PMI, or what are called Purchasing Managers Index, and this is when the purchasing managers are surveyed, and those survey results are tallied, and to get a pulse of the manufacturing and services sectors. So starting with Australia, what we saw is after a decline the previous month, that things were pretty much unchanged. So the way you read this is 50 is unchanged from the prior month. Greater than 50 means things got better, and below 50 they got worse. And depending on how much over 50 and under 50 is the degree of how much better or worse things got. So when you see a print of 49.8, it says relatively no change in the Australian manufacturing sector for June so far. How about the services sector? A slight improvement after the thing blew apart the month before. So on one hand, you go, well, that's great, it got better. Yeah, when you look at the previous month of 26.9, it said it only slightly got better after the prior month's grenade. So bad previous month, slight improvement, but nothing showing any really change in the Australian manufacturing or services sector. How about Japan? Japan is in serious problems. They are in a recession. No doubt they had a big down to 38.4 the prior month. And look at this, another print in June, 37.8 in their manufacturing sector. Tells you that whatever's going on in Japan, it is not good. How about their services PMI? Just destroyed, much like Australia, in May at 26.5. And look at June, and another contraction, 42.3. This tells you whatever's going on in Japan is bad news. So let's move on. This is Singapore. Consumer Price Index on a year-over-year basis went from minus 0.07 to minus 0.08. And let's move into the Eurozone. French manufacturing PMI, slight improvement from last month's down. And I don't know what's going on in the French economy, but it appears to be the cleanest shirt in the French economy at the moment. And the composite, which is a blend of services and manufacturing, it was a slight improvement after a pretty big drop the prior month. And the services PMI was relatively flat after a big drop the prior month. So improvement in the manufacturing PMI in France, but overall not, we'll just say unchanged. How about Germany? And Germany is, again, the manufacturing engine of the Eurozone. And its composite PMI, a blend of manufacturing and services, after detonating the prior month at 32.3, slight contraction at 45.8. So no improvement in the German economy at all. How about the broad Eurozone? Looking at the market composite PMI, again, big drop, 31.9 the prior month, and a slight contraction to 47.5, suggesting that nothing improved in the Eurozone at all. That's not good. So for those looking for a V-shaped economic recovery, you're definitely not seeing it in Japan. And the Eurozone is telling you, look, we're on an L-shaped recovery. There's nothing going on here at all. How about Great Britain? Its composite PMI dumped the prior month down to 30. And the preliminary report says for June, slight contraction to 47.6. Again, slight contraction, so no improvement. This is not good. No improvement out of the United Kingdom. Let's move into the U.S. data. Well, we see the Redbook weekly retail sales. This is something I think only Chris Dark and I really actually get excited about, and we're trying to figure out, is the Redbook really accurate, or is the actual retail sales data from the government accurate? And they're both now diverging. So Redbook says, hey, we only went down minus 1.4% from this week last month, which was a slight improvement over the minus 2.4% from the prior month. And on a year-over-year basis, it also was a slight improvement to minus 6.1%, but still showing that retailers are not seeing a big improvement despite all the stimulus checks the government sent out and stores reopening. How about the market composite PMI out of the United States? Last month, big drop to 37.0 and a slight contraction to 46.8, showing no improvement in the manufacturing or services sector in the United States. New home sales, after being revised lower, shot higher on a month-over-month basis in May by 16.6%. I don't know what's driving the housing market in the United States, but people are happy about it. Now, the Richmond Manufacturing Index, these do not map out like the PMIs, and I believe this is one where they take the pluses and subtract the minuses. All told, it says things improved slightly in the Richmond Manufacturing Index and the Richmond Services Index. It doesn't mean things are rosy. It just means they did actually improve in June. So we went flat on the manufacturing index, and we're still negative on the services, but mind you, this index was quite a bit higher. If we go click in, you can see that before we actually had a print of 20, and it was ranging somewhere between, on the low side, 3, on the pause up to 20. So being that it's at 0 right now is good, but not certainly showing that there's a big turnaround in the Richmond manufacturing sector at all. We had a pretty decent 2-year note treasury auction, which was good. And let's move on into what's going on today's data. I did not look to see how they calculate the leading index in Japan, but it didn't get better. And based on the data, we know things are not getting better in Japan. How about mortgage applications down 8.7%? This is very volatile. We saw for the first time in about 9 weeks purchase applications drop. Again, I have no idea what's driving the U.S. housing market right now, but it seems like people here are wanting to buy homes. And as a result, house prices went up 0.2% month over month in April, and impressive 5.5% on a year-over-year basis in April. So the coronavirus shutdown, at least so far, it had no negative impacts on housing prices. But don't worry, when deflation eventually catches up to the housing market, it will. Looking at crude oil inventories, big build at 1.442 million barrels. And you see distillate stocks rose 249,000 barrels. Gasoline saw a pretty decent drop of minus 1.673 million barrels. One thing I did note in the report is that crude oil production was up. Remember, the market is betting heavily on crude oil inventories going down and crude oil prices going up. Obviously, this was not bullish for crude oil prices, which fell today. But again, you saw producers starting to turn back production up or bring back production, because even at 40, they might not be making money, but they're bringing some money in. 5-year note auction was the largest 5-year note auction in the history of this country. And many people were expecting this to not go well, and it was met with very strong demand. So the whole idea that nobody's interested in U.S. government debt, well, that's not true at all. All right, so back to the question of the M2. So do you have an answer? Is stimulus inflationary over the short term? What do you think? Yes or no? How about the longer term? Well, over the short term, yes. The longer term is questionable. We don't know. So let's go to the M2. We'll have an update on this on Friday, but everyone sees this big turn up in the money supply is very, very inflationary. Now, so here's what you need to understand. In the short term, government transfers, when someone gets that money, what do they do with it? Well, they deposit in their bank account. And when the M2 money supply is rising faster, I'm going to use just to have an arrow, faster than the monetary base, it is inflationary in the short term. Now, we know the Fed is still buying $120 billion per month in their quantitative easing program. This is a floor. So in order for the Fed to offset the rise in the money supply has to grow less than $120 billion a month, because we know what the Fed is doing. Now, a strike against the Fed is their repo operations, which are short-term dollar loans. They're starting to roll off their balance sheet, at least the last couple of weeks. Now, we don't know until tomorrow if that's stabilized or not. But over the longer term, we do know the Fed is going to catch up and pass them. So in the short term, as money hits bank accounts, it is inflationary because it goes into the M2. The question then is, where does it go next? Now, if that money eventually goes out to pay living expenses or pays against debt, such as mortgages, student loans, home loans, or car loans, and credit card loans, then it is destroyed. So when money goes to pay the principal value of a loan or the principal part of a payment, it is destroyed. So if it's using for living expenses, then it's not inflationary at all. In order for it to be inflationary, it needs to get out into the real economy, spent on discretionary goods, preferably used to borrow money to buy foreign-produced goods. So we don't know over the long term if the M2 will be inflationary or not. Because what a lot of people don't understand is debt is deflationary. The more debt I have, the more deflationary it is, because what happens to my discretionary spending when I have a lot of debt? Well, it has to go down unless what? My wages go up to create more discretionary spending. So when you see savings, when savings rates are rising, it is inflationary, because the assumption is if I'm saving to buy a new car, when that money comes out of my bank account and goes to buy the car, then it gets out in the real economy and can be inflationary. So the question is all this money building up in the M2 inflationary or not? Well, the reality is it probably won't be, but it will be in the short term. So corporations have borrowed a lot of money and stacked up that money in their bank accounts because they're cash flow negative and they're concerned about the future. Consumers are stacking up cash. They're not paying bills, but they're starting to build up cash because they don't know what their future looks like. And then we know investors are raising cash because they're concerned about the future. The only question is, where does this money go next? And that's why I'm not convinced over the long term the M2 is inflationary, but the market is acting like it's very, very inflationary. All right, let's go and take a look at some charts and see what's going on in the world here. Let's start with the dollar. You're like, wait, we're not starting with bonds? Don't worry. You can't leave bonds out. All right, so what's going on with dollar? Why did it sell down here? Well, remember when we looked at how hedge fund managers were positioned? They used to be long the dollar. Now I think they're still short, or they're slightly long the dollar. So they were dumping dollars as they were exiting their speculative long positions, and that drove the dollar down. It came into the supply zone where it found buyers, and it went up and it touched the bottom end of what is another supply zone, and there were sellers there. And I think on Monday I mentioned it probably could get down and touch the bottom end or top end of the supply zone, which it did, and then it held there and rallied up. What you are seeing, and again, I'm not going to field any questions on Elliott wave theory, so don't bother asking them. But if you are a fan of Elliott wave theory, all Elliott wave theory is moving in between supply zones. That's all it is. So if you can identify the supply zones, then you kind of get what's going on. So we found that there are buyers at this supply zone, or no more sellers, and that means the next move for the dollar should be to retest up here on the bottom of the supply zone, and if there are no more sellers here, it should move into that zone. Now, we do know there is a relationship between the dollar and the long treasury bond, which we can look at the largest treasury long-term ETF, or long-term bond ETF, TLT. And what we see today was a very bullish move higher, probably also met by the fact that there were rebalancing going on. So money managers were forced to start selling stocks to buy bonds. And that put a nice bid under the market. Plus, there was a very strong 5-year treasury auction. And who knows if this after hours move will hold. But if it does, that means that 30-year yields are knocking on 1.4%-ish starting tomorrow, which would be pretty cool as far as I'm concerned. And if we zoom out a little bit, what we see is roughly where 1.4% is the next major line of what's called resistance or overhead. Think of it as a ceiling. So where you have sellers at 1.4, where this solid purple line is, sellers here, sellers here, sellers here. But once we found a bottom down here and in here, what happened? As prices went back up, the sellers got weaker and weaker. And what happens is once those sellers are out of bonds to sell, or maybe they're not interested, it starts to break through, and those sellers end up oftentimes becoming buyers. Well, over the course of probably the next 5 trading days, or 4, next 4 trading days, we should continue to see a demand for treasury bonds and notes and bonds in general due to the rebalancing. So as someone who personally is treasury bond bullish, I'd love to see it break through this resistance here, get back up into this bigger supply zone. So here's the supply zone, and eventually a breakthrough 1.2 all the way as I believe interest rates head to 0. And we can see that in the 10-year treasury yield, which is just sitting on the edge of breaking down out of a channel here. It's very, very close to breaking through and saying, hey, this is a topping pattern, and down it goes. So if you're kind of wondering how to draw some lines, there's an idea. Let's take a look at emerging markets, my proxy for liquidity. Where did it go? And emerging markets look like they're making a small double top here. Again, my outlook for emerging markets is not pretty. I believe we're probably going to see a blow through this low here as deflation takes over the economy. That should be bearish for gold prices, and we can take a look at the large gold miners. I know a lot of people think this goes straight up, and it may be. I may be wrong, but remember, there is a relationship between gold miners and emerging market stocks. So if you miss one and if gold takes off and emerging markets bottom and you really want to be in gold, you can always play emerging markets. But otherwise, there could be a big move down into these lower supply zones. If there is, to match emerging markets move down, that would be a nice confirmation. How about the S&P? Let's move out and take a look at that broadening megaphone pattern. Zoom out some more. And right there at the top, it appears to be holding resistance. So if this breaks down, then that suggests we could have a potential double bottom at March on the bottom of the megaphone. If not, well, then you're looking at a much larger drop in the S&P 500, potentially down to, I think we talked about this in a video the other day, somewhere between, maybe around 2100 or below. I mean, somewhere going back all the way to the 2016 lows. I mean, that would be very interesting, potential bullish opportunity. And who knows, maybe if things get really ugly, it goes down further from there. But this megaphone, which you see here, is either a topping pattern or a bottoming pattern. And if it breaks down from here and goes lower, it's telling you this is a topping pattern. The only question is, will it hold at the bottom and make another run, or will it break through the bottom? So the idea is when it breaks through the top, it should be a big bullish move. Well, we had one fake out. We had two fake outs. So it's kind of suggesting that we're seeing a potential beginning of a large move lower in equity prices, which would match a large move higher in bond prices as yields go to zero. And then that should bring emerging market stocks down with it, gold down with it, and then a big bullish breakout in the dollar. Now, where does the dollar go? I don't know how high the dollar gets. That's not the dollar. There's the dollar. All I know is its peak is at 103. If it breaks above 103, bad things are coming. How high this thing goes, I don't know. But a lot of people don't understand, why is there a relationship between the dollar and the stock market? And let's kind of overlay that. And you can see in the short term, we'll zoom in a little bit. Maybe not so much. Yeah, you can see in the short term there's a relationship. When the dollar shoots up, it usually is fairly bearish for stocks. Well, think about this. When people sell their stocks, what do they get? Dollars. Well, when there's a dollar shortage and people are selling stocks and wanting dollars, that sends the dollar higher. And of course, there's your potential move down in gold, emerging markets, and your move higher in bond prices. So it's in the period during times of dollar shortages, things can get pretty ugly. Let's go ahead and take some of your questions. And just kind of as a preview, I should mention you will be getting a Q&A video on Thursday. So look for that. And then we have one this weekend. So let's jump in, grab a few questions, and see where this goes. Thank you for your videos. Things make sense when I watch your videos. That's pretty cool. Thank you. However, as soon as I turn on the news or look at Twitter, I get confused. Yeah, don't worry. I'm with you. I can 100% see the value in blocking out the noise. I agree with you. There is a dollar shortage in the world, and I agree of a potential new market bottom. I also fully appreciate the relationship between 10-year U.S. Treasuries yields, I'll add yields, and U.S. stock market prices since 1988. I can see the data. It's clear we are in a deflationary phase. Thank you for showing us the data. I suggest this may be partially by the Fed, partially supply shock, partially demand shock. Yes. It's going to be across the board. Well, you're very welcome. One possibility, if I may propose, is the Fed, which typically moves 1 to 2 years in advance to create inflation. It might overcorrect for the economic fallout of COVID-19. This could eventually lead to inflation next year. I do not ever expect America to experience hyperinflation, as famous authors such as Jim Rickards and Peter Schiff have suggested, simply because we are the world's reserve currency and there's always demand for U.S. dollars. Hey, there you go. Right on. However, I do anticipate some level of inflation to come simply because the amount of blood that has been pumped into the system is overwhelming the circulation. Now, the person who sent this in is a doctor, so hence the reference to that. So let's go and look at the question is, the Fed moves typically 1 to 2 years in advance. So what's interesting about monetary policy is they don't lead. The Fed is very reactionary. Now, remember, the Fed is data-driven. Okay, so the Fed has their meetings, looks at their data, and then reacts to what happens. But what most people don't understand is the transmission mechanism of what the Fed does before it reaches the real economy is a function of how much debt is in the U.S. economy. So the more debt the federal government has, the longer it takes monetary policy to actually affect everybody. Meaning it runs in approximately, I'm guessing based on my data and that of others, somewhere around a 2-year lag. Meaning we're still feeling the tightening effects on a global basis of what the Fed did 2 years ago. Remember, they didn't start easing or stop their tightening until like October, right around the time of the election. So we're still feeling the effects right now of those $50 billion per month balance sheet roll-offs that was supposed to look like paint dry. Well, those are what I call atomic monetary bombs. I mean, they're hitting boom, 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 and that is going against us. So all this easing we're seeing now, you'll notice it's really not having any effect. It shouldn't. It should take about 2 years, and that as we build up debt, that lag gets longer and longer and longer. So no, we're not. The Fed is not leading. The Fed is reactionary, and then it's reactionary with a lag, and that's why the Fed will do something, like it did in March. Print the money, and then it waits, and oh no, things didn't get better because, well, it hasn't been 2 years for that to really push through the economy to see what happens. So the Fed often overdoes it, but for those who know that, when the Fed overdoes it, what does it do to the money multiplier? Well, it's very bearish for the money multiplier, which is very bearish for yield, which is also very bearish. You know where I'm going with this because I got 3 red arrows. Bearish for stocks. Let's go on. So I am wondering, how would U.S. equities behave during an inflationary environment since we've never seen one before? Well, we have. We just haven't seen hyperinflation. And we have seen periods of high inflation, but usually equities, if you go back and look at 1966 to 1982, a period of high inflation. In fact, why don't we do that? Stocks didn't do very good. And everyone thinks that, stocks are the greatest thing to own during inflation. No, not at all. Let's see if no, you know what? I don't even think my chart, it does. They used to not. 1960, wow, that's pretty cool. 66 to, where, wow. So 1966 to, there, 82. There was your big move during inflation, which was effectively nothing. The only way you made money in this market is if you could somehow move through these cycles. So high inflation is not good for stocks. Hyperinflation is bad for stocks. Moderate inflation is good for stocks. Low inflation, not so good. Deflation, bad. So hopefully that answers your question on that. How about U.S. Treasuries? Well, that's obvious. The U.S. Treasury yields go up during periods of inflation, and that would mean lower bond prices. After reviewing Buffett's prior letters and recent meetings, I interpret him saying that precious metals have no intrinsic value, and although they might outperform equities during an inflationary environment, they tend to, the opportunity to build long position equities during the price dislocation with a plan to hold for 10 years, of course, because one never bets against America. What are your thoughts? Well, he's right. The long-term precious metals do not outperform equities, but there are periods that do. And they do well during high periods of high inflation. But you got to understand is what Buffett's investment philosophy is and how he makes his money. He lives off his dividends. That's what he does. You've heard him say that my tax rate's lower than my assistant's because he doesn't probably take an income. So for him, he wants to buy stocks low. He wants to own the companies, clean them up, and then get them to raise their dividend rate so his income goes up. So that's what he's focused on, is buying those dividend-paying stocks, buying them cheap, and then having them get better over time. So maybe you, in the shorter term, when there's high inflation, you play the precious metals market, and then you flip back into stocks. But remember, he buys what he likes, and he talks about what he likes, and that's totally cool. P.S. I was redeployed as a frontline ICU physician from March to May in New York City, and I can confirm that COVID is not a hoax. And wearing masks is very effective. I was tested 3 times because of my extensive exposure to COVID-positive patients, and I'm negative. Amen. I'm very happy to hear that. But simultaneously, I have to explain COVID doesn't kill everyone or affect everyone. Approximately 80% of patients only have mild symptoms. So I hope everyone is following your channel. That's why I wanted to read this, is being safe and considering the health of others who may not be able to handle this viral pathogen as them. He did follow up and tell me you should wear a mask. They do actually work. So thank you, doctor. We appreciate it. Hope you stay safe, and we'll look forward to more of your questions. All right, let's see. I think we can do a couple more. With the Fed buying high-yield corporate ETFs, would you expect the high-yield index would be affected by fundamentals within the index, or the Fed's buying the ETF, or both? In the short term, the Fed's buying is having some effect. Long term, it should be the fundamentals. We can look at a chart of that. I'm just excited that they finally gave me historicals on the S&P 500. This platform didn't have that. Where's bonds? Bonds. Here they are. High yield bonds. Let's go and look at the last 12 months. So here was the big announcement when, let's zoom out a little bit. Here's the big announcement. Fed's going to buy, shot it up. Prices went down, went up. So really, it's not doing much for all the Fed's buying. So I'm going to go with fundamentals on that long term. Would the Fed buying tend to counteract the index fundamentals as a number of defaults increase? No, I don't think so. I could be wrong. I mean, this is really uncharted territory, so we don't really know. But I'm going to go with the fact that the Fed can't counteract defaults, nor can the Fed stop if there's a massive amount of downgrades from corporate to junk. That's what they're afraid of, is if there's corporate bonds are downgraded to junk, the junk bond market cannot swallow all of them, and that would mean higher or lower junk bond yields? Higher junk bond yields and lower junk bond prices. And guess what happens when junk bond prices go down? Oh, I will show you. How do they relate to stock prices? Do you think that junk bond going down is good for stocks? No, it's bad. It's really bad, because junk bonds and stocks in the short run follow each other. So you can see that if junk bond prices went down because the rates went up, that would pull stock prices with it. So the Fed's going to try to offset it, but I don't think they can. I mean, we'll find out, but I just don't think they can do that. Let's see what the next question is. This was a longer one, so we'll just wrap up since we're at the 30-minute mark, which is a good place to end anyways. I think keeping the videos around 30 minutes is appropriate. So thanks for watching. As always, look for tomorrow's Q&A video, and then we'll be back on Friday for a regular, look at the credit data and all that. And then if I have enough questions, you might get a weekend video too. I'm Steve Van Metre. Thanks for taking the time to watch. I appreciate you and appreciate you being here with me. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It is not to be construed as recognition or solicitation by a selling security, financial planning instrument, or participate in particular trading strategies. This video was prepared by Steven Van Metre on personal capacity. The opinions expressed in this video that I do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.